Lefty glasses. Okay, hello. It's always a pleasure to be here to present at Denver. So thank you for your attendance. There's the disclaimer and the forward-looking statement. Right, talking about Caledonia, and the recurring theme through this presentation is we've got a very simple formula which has stood us and especially our shareholders in very good stead over the last 10 years or so, which is a combination of yield and growth, which has delivered really demonstrable value for our shareholders. And that's in the DNA that we're going to take forwards in terms of our further development. We're an established Zimbabwe gold producer with an existing core asset, but we have a multi-asset development strategy in Zimbabwe. So we're focused on growth, currently producing just under 80,000 ounces a year, targeting about 200,000 ounces of annual production, supported by a core cash generative asset. In Zimbabwe, we are uniquely positioned with a very high quality asset base, which we put together over the last sort of 4 or 5 years. We're a major presence in country, and the thing that our USP in Zim is, Zimbabwe is much misunderstood, and we'll talk a little bit about that later on. But we've actually got the ability honed over the last sort of 10, 15, nearly 20 years to actually operate successfully through the quite complex administrative structures in Zimbabwe. And we've delivered strong financial returns. Consistently, we've been paying quarterly dividends for the last 12 years or so. So we've repaid over $60 million to shareholders, and long may that continue. So just to look at an overview of the portfolio, we've got a production asset being the Blanket Mine, which we acquired in 2006 from Kinross for about $4 million. As I'll say in a minute, we finished a central shaft expansion project, so we've doubled production from about 40,000 to 80,000 ounces a year. This year's guidance is just under 80,000 ounces a year at an on-mine cost of about $1,100 an ounce. And I think it's fair to say that over coming years we can give that some very serious good look at it and try and get that down a bit. As you'll hear later, we've restarted exploration and we've substantially increased our resource base at Blanket. The development project is an asset called Bilboes, which we acquired in January 2023 for about $65 million, settled through shares and a 1% NSR. It's big. It's got an M&I resource base of nearly 2.5 million ounces, and it's high grade at 2.3 grams a ton. We published a PEA a couple of years ago, which shows an average production of about 150,000 ounces a year over a 10-year life of mine. We've got a pre-development asset called Marley Green, which is a bit smaller, so that's only 800,000 ounces, but then that's probably going to be overtaken by an early-stage exploration project called Matapa, which is immediately adjacent to Bilboes. And in the 80s, Matapa and Bilboes were both held as a single entity by Anglo American, and we're delighted we've put those two assets together. Just look at our strategic evaluation over the course of the last 10 years or so. 2015 to 2020, we were a single asset operation focused on the Blanket Mine, producing about 40,000 ounces a year with a relatively limited horizon. It had 1 million ounces of resources. And at that point, we decided we got no choice. We had to take the mine deeper by sinking a central shaft, which I'll talk about in a moment. From 2021 to 2024, we commissioned the central shaft at Blanket, so we increased production to about 80,000 ounces. We were able to restart exploration at Blanket, and that substantially increased the resource base. We acquired Marley Green, Matapa, and Bilboes to give us a really high-quality development portfolio in Zimbabwe. We commissioned a 12-megawatt solar power plant, which we built and paid for ourselves, and that went some way towards addressing the recurring power situation in Zimbabwe. And we started production. We started exploration at Matapa, which has shown some very exciting results. So looking forwards, 2025 onwards, we still expect Blanket to continue producing at about 75 to 80,000 ounces a year. We intend to develop and operate Bilboes, getting about 150,000 ounces from Bilboes. And we will then evolve into becoming a leading intermediate gold producer, producing, say, 250,000 ounces with potential for further growth beyond that. Let's just look at our value creation. On the left-hand side, it's quite small, you may not be able to see. On the left-hand side, we talk about the value creation in country. Obviously, working in a place like Zimbabwe, you've got to have an eye on the local perception. So we've paid about $50 million in taxes in Zim over the last 10 years, half of that in 2024. And we make substantial investments in both the local community and we've got local shareholders. The local community has a 10% interest in the mine, as do the employees. So that's in country. The Bloomberg graph on the right may be a little bit hard to see, but that's looking back over the last 10 years, from 2015 to 2025. During that period, we doubled production from about 40,000 to 80,000. During that period, gold has tripled, the GDXJ has quadrupled, and we've gone up tenfold, actually 11-fold today. And what underpins that outperformance is a disciplined approach to equity dilution, minimal or zero, a continuation of a dividend policy, and both of those two factors inform how we intend to turn Bilboes to account. Minimizing dilution, continue to pay a dividend, and as and when Bilboes is running, to pay dividends to shareholders. Zimbabwe is always the biggest issue facing investors. It's fair to say we believe, having operated there since 2008, it's a much misunderstood jurisdiction. Physical security in Zimbabwe is absolutely not an issue. We all travel freely to and from the mine, and our goods travel in and out with no difficulty at all. The historic problem in Zim has really been foreign exchange stability, and everyone knows the hyperinflation that occurred there in 2008. As a dollar producer, we really have very little exposure to that. That's not our problem. But what we have seen in recent years is an increasing liberalization of the foreign exchange regime in Zimbabwe, driven by the new governor, who shows an enormous fiscal discipline and rectitude in terms of not printing local currency. And again, long may that continue. The workforce in Zimbabwe is outstanding. We've got about 2,400 employees at the mine, and we wouldn't have been able to deliver the results we delivered over the last 10 to 15 years without a high-quality local workforce. So about 2,400 at the mine and 10, 15 in Johannesburg, providing finance and specialist technical support. The only real operating problem in Zimbabwe is electricity. There isn't enough of it. But again, the government has been conspicuous in moving very quickly to allow companies like us both to put in place our own captive power solutions. In our case, it was a solar plant. Then also establishing a mechanism whereby we can import power from Mozambique and Zambia, where there is no shortage of power. So government has been very proactive and quite flexible in facilitating that. And I think that's reflected in the most recent Fraser Institute ranking, where Zimbabwe previously had propped up the bottom of the list. And actually, the most recent result showed Zimbabwe moving up to be a mid-tier producer in Africa, a mid-tier ranking in Africa, 8th out of 17. And that reflects with our own day-to-day experience of working in Zim, and it also reflects the engagement that we've had here and in Beaver Creek, where increasingly investors are beginning to recognize that Zimbabwe is actually an attractive and investable destination. Just very quickly on Blanket Mine, which is our current cornerstone asset. We over the course starting 2015, finishing in 2021, we sunk a new shaft, a 4,000-foot shaft from surface down to 4,000 feet, 6-meter diameter, 4-compartment shaft. We funded that using our own cash, internal resources, and with our own people. Having got that shaft operational, we were then able to increase production from about 40,000 to 80. And as you'll see, we then restarted exploration with some quite exciting results. So having restarted exploration, we published a very substantial resource upgrade last year, which effectively showed total reserves increasing from about 400,000 to over 800,000. So that's a 10-year life of mine based on reserves, and a very substantial increase in resources as well. So Blanket has plenty of legs left yet, and we're going to use the cash that we generate from Blanket to contribute to growth elsewhere in the business. Let's look at those growth projects. So the first one is Bilboes, which will be our next mine, and that will take us up to intermediate status with production of over 200,000 ounces a year. It's 100% owned. It's fully permitted. As I've outlined, it's got a large resource base at high grade, 2.5 million ounces at 2.3 grams a ton. We published a PEA about 2 years ago now, so it's a little bit out of date, which shows a total capital cost of about $400 million and a very attractive internal rate of return of about 34% using a relatively low gold price, $1,884, and a very, very compelling all-in sustaining cost of about $1,000 an ounce. Okay? In terms of how we take that project forwards, it's fair to say that the environment has changed and continues to change quite rapidly for the better. Okay, so as the gold price goes up and as Blanket's performance improves, our own internal cash generation improves, but also the returns on the project are also looking very good. And so one of the things that we're trying to do, if you go back to where I started from, about minimizing dilution and running this business to maximize NPV per share, what we're currently grappling with is how to commercialize this project, either in a big bang or in a phased approach, with a view to optimizing NPV per share. That means balancing growth and minimizing dilution, at the same time maintaining a prudent sort of fiscal approach. We can't gear this company up too much because clearly the risk would then be if relatively modest deviations from plan could have an adverse effect. So frankly, what we're doing at the moment is really trying to look at all the available alternatives with a view to identifying the best development plan, and that is taking some time. Motapa, which is it was an asset we acquired a couple of years ago. I think we paid about $8 million for that. It's big. It's 2,200 hectares, or about 8.5 square miles. It has been historically mined, both by Anglo-American and more recently by artisanal miners. We started exploration there last year, and we had some really very exciting results, grades of up to 10, 11 grams a ton, all relatively shallow, only down to 60, 70 meters. So we're continuing now to do further exploration there with a view to, we're spending about $4 million this year, with a view to looking for relatively easily accessible, quick oxide opportunities that we could turn to account quite fast, just by trucking the material to Bilboes, where there is already processing capacity for oxides, but also looking for deeper level sulfides, because that is actually going to be the future for Motapa as a deep level sulfide operation, very much along the same lines as Bilboes. So in due course, we would expect Bilboes and Motapa in due course, 5 to 7 years, to operate as a single, very large operation. Operating in a place as economically challenged as Zimbabwe, you need to have an eye on your ESG. So we adhere to the highest levels of governance and ethics. We're SEC registered, and we have a comprehensive compliance regime. Clearly, we take health and safety very seriously. The management team has been recently refreshed with a new chief operating officer who we recruited from Harmony, and we've made great strides in further improving our health and safety performance. Communities and society in a place like Zimbabwe are very important. So as I mentioned, the mine is 10% owned by the local community and 10% owned by the workers. And at this gold price in 2026, both the workers, not individually, the worker trust and the community trust, they can both expect to receive about $10 million of dividend income from the mine, which makes an enormous difference in a place like Zimbabwe and gives us an impeccable cast iron social license to operate. We take our environmental obligations seriously. We're just finishing off an investment of about $34 million in a new tailings facility, and we continue to invest heavily in our people. So just in terms of outlook, we're going to continue with Blanket at about 75,000 ounces a year. We'll complete a feasibility study for Bilboes, optimizing to balancing growth and dilution, and start to turn that to account. And we'll continue to invest in the company to create long-term returns for shareholders, which I would hope far exceed what we've managed to deliver over the course of the last 10 years. And then clearly at the end of that will be a multi-asset, mid-tier, Zimbabwe-focused gold producer. Just some basic information, we're a Jersey-registered company, Jersey Channel Islands, but the bulk of our trading takes place on the NYSE American. So trading there can be 200,000 shares a day. London, maybe less so, 6,000 or 7,000 shares a day. We've got relatively few shares in issue, just under 20 million shares, and only 10,000 options outstanding. So it's a fairly tight share register. So I think pretty much that's it. With a couple of minutes left, if anyone's got any questions, I'm happy to take them.
Great. There's a question right there, please.
Mark, the Bilboes project, the startup PEA, is there any potential there for a staged startup?
That's very much what we're looking for. There's a big bang approach, which is big and attractive, but we're very much looking at a phased approach, and that's exactly what's taking the time. So that would de-risk it financially. It's just much easier to digest, but clearly it all comes down to what gives the best or an acceptable return for shareholders. So that's exactly what we're focusing on.
And is there any synergy with your existing plant? I guess we didn't have a map there.
No, not at all.
It's too far away.
No, I mean, it's not just it's too far away. Bilboes is a refractory ore body, so we'll be using BIOX technology to process that. The operation at Blanket is a free milling sulfide with a straightforward CIL operation, so there's no synergies there. Bilboes is about 70 kilometres north of Bulawayo. Blanket's 200 kilometres south. We have got a hub in Bulawayo which will provide technical services, but in real operational terms, there's no scope for synergies. Any more? Well, 1 minute.
Maybe one question from me, Mark. As you mentioned, Zimbabwe has improved. Fraser Institute now ranks Zimbabwe 8th out of 17 in Africa. But what does the country need to continue to deliver on to continue to improve on that ranking?
I think the only thing they really need to focus on is continuing the liberalisation of the foreign exchange. That's basically it. Security's fine. Electricity, people like us can sort that quite easily. I think it really comes to digging in and continuing the work that the new governor has started to give people increasing confidence that Zim's economy isn't going to crash and burn again. Even if it does, it actually doesn't affect us, because as a gold exporter and a dollar earner, that doesn't really affect us. But it's all about perception.
Great, thanks, Mark. That's all the time we have.
Thank you.